Central banks such as the US Federal Reserve can have quite the impact on financial markets. So I thought we'd take a look at what we can expect this year and which markets we really should be watching. Probably the obvious markets to watch are currency markets. I've got a chart here of euro US dollar. Clearly anything that the Federal Reserve does that may affect the US dollar is going to have an impact on euro dollar, pound against the dollar, also the price of gold and silver. But there are other markets too. A bit later today, we've got a really important release from the Federal Reserve. It could be a challenging year for the US's central bank. So in this video, I'll talk a bit about what it's done over the last 12 months, what to watch out for in the year ahead. Then we'll come back and look at some of the markets to track around these Fed announcements that can give us early clues as to perhaps a shift in sentiment and trading opportunities. Hello, I'm David Jones from Capital.com, and I thought we'd do one of our slightly different videos looking at the US Central Bank, the Federal Reserve, looking at some of its policies. It has been in the news over recent days because it is going to stop publishing certain money supply data. We'll talk about that. But also we have the release of its minutes due out a bit later today. This regular event can have an impact on market. So I thought, well, let's do a short session on what the Fed actually does and the impacts it can have, the markets to watch and how we can take advantage of it. So I'll talk about it a bit, then we'll jump on the platform and take a look at some markets that I think you should be watching when there are Fed announcements. As usual, if you're watching this and you haven't subscribed, if you could click on subscribe, it does help support the channel. It means we can continue to push out regular videos throughout the week on the various markets that we cover. So the US Federal Reserve is, of course, a central bank. The vast majority of economies around the world have a central bank. These are typically independent from government, and they are responsible for setting the monetary policy for that particular country. The most obvious activity that central banks such as the Fed get involved in is deciding what the interest rate is going to be for that country, and it will set the interest rate based on its fears, perhaps about inflation. The classic way of controlling inflation is to raise interest rates, or if it's worried about the state of the economy, if it wants to try and boost the economy, then one way of doing this is to lower rates. Another role of central banks is as the so-called lender of last resort. So when there's no one else that financial institutions can borrow from, the central bank's role is to step in. And we did see this. If we go back to the financial crisis, we saw plenty of banks around the world struggling, both in Europe, UK, US. We saw plenty of intervention by the central banks there to try and prop up and help these struggling banks in the eye of that financial storm. It's also involved in the supply of money into the economy in various different ways. For example, quantitative easing, QE, we saw that really start and get ramped up during the financial crisis. It's something that's continued today. If we look back over the last year with what happened during the pandemic, the effective printing of money, and again, a way of trying to keep the financial system, the wheels of the system turning. So let's get into the details for the Fed, as it's often referred to. So the US Federal Reserve, the American central bank, was set up in 1913 in response to a number of financial crises that had happened up until then. It's like the big one coming, of course, in 1929, then the Depression in the 30s. But it was a way of hopefully trying to have an institution to maintain order in the face of various crises. What financial markets tend to focus on a lot when it comes to the Fed is the Federal Open Market Committee, the FOMC. This is the committee that sets interest rates. It's made up of 7 members of the Board of Governors of the Fed, and also the presidents of 12 regional federal banks within the US. So the FOMC plays a very important role for the US economy and its wider impact on markets. So what does the Fed do that affects markets? The obvious thing is interest rates. If we see interest rates change, that can have an impact on a whole range of markets. The obvious one is the currency, the US dollar, but of course, lowering of interest rates, has in the past boosted stock markets. But it's not just the action of moving rates that has an implication. It's also press conferences, for example, which can give some insight as to where the Fed sees the economy going, where it sees rates going. Speeches by various Fed members can also have an impact. And of course, like later today, the minutes of the latest meeting, again, can show some color around why they've decided to either hold rates or reduce them or raise them. So there's a whole collection of events, aside from the actual rate decision itself, that can have an impact when it comes to interest rates. So let's look at some recent Fed policies. If we wind the clock back to March, from March to December of 2020, we saw the US central bank, the Federal Reserve, cut rates by 1.5%. This perhaps is not a surprise. It was a move done by many central banks, reducing interest rates. And it was in response, of course, March last year was when we saw the pandemic, the coronavirus, really take hold and spread around the world. It was in response to that. And it was a measure taken, or a series of measures taken, to try and protect or stimulate the various economies in the face of this crisis. The Fed is still very cautious on interest rates. It gives forward guidance, like many other central banks, so some ideas of where it sees rates going in the short to medium term. And it said it is committed to keeping rates low, even if inflation goes above its target temporarily of 2%. You know, it's doing this, it sees, to stimulate and protect the US economy. But it also got involved in QE during the pandemic. From March to December last year, it bought various treasury and mortgage-backed securities. It saw its portfolio in this area swell from $3.9 trillion in March last year to $6.6 trillion. So this, again, is QE, quantitative easing, getting involved and buying these securities. It's been in the news lately because it said it's going to stop providing money supply data, so-called M1 and M2 money supply data on a weekly basis. It's going to shift this to a monthly release. So M1 covers the part of the economy that's coins and notes, for example, readily available cash. M2 is savings, deposits, and mutual funds. And some people perhaps see a conspiracy here, that perhaps the Fed is trying to hide something, but it definitely does show, I think, a change in attitude and a change in stance by the US Federal Reserve. And it's seeing this weekly data as being much less important than it has been in the past. So let's talk about its impact on markets. We have the latest minutes from the Federal Reserve being released later today, the last meeting that the FOMC had when it came to setting rates. So again, traders and investors will tend to pore over these minutes to see what clues they may give about the future direction for rates, and perhaps a change in stance on keeping rates low from various members of the committee who decide where rates are going to go. And the Fed does have some challenges. You know, we've seen some recent strong economic data. For example, the latest jobs report, we saw 250,000 more jobs being added than was expected in the last month. I think the number came in at 900,000. The market was expecting 650,000. So a stronger economy, a stronger US economy, or stronger than was expected, does provide a challenge for the Fed. They've said they're happy to keep rates low, but do they really want to do this if the economy suddenly races ahead of expectations? Because, of course, the risk then is that we have inflation. The Fed has said it's fairly relaxed about inflation. Markets perhaps aren't so relaxed. So that's, again, something in the minutes, I think, today and in the months to come that will be closely watched. Already, markets are bringing forward their expectations for the next rate rise. It wasn't being expected for a couple of years, sort of in early 2023, the next rise in the US. But now financial markets are pricing a rise, and it's still a while away, but for around December 2022. So it's going to be really interesting to see how the Fed reacts, I think, in the months and perhaps the year to come as vaccination rates increase, as we see economies get back to normal, economies performing perhaps stronger than expected. Does this force the Fed's hand on interest rates perhaps quicker than it was expecting, and the corresponding impact on markets? Let's take a look at some of the financial markets you should watch around these Fed announcements, and that can help you take advantage of perhaps a change in stance and attitude by the US central bank. So currency markets are an obvious one to watch. Here's Euro US dollar, the most widely traded FX pair. I think this is interesting at the moment anyway, Because in January of this year, we did see the euro against the dollar hit its best levels. We had to go all the way back to April 2018 when the euro was last this high. But perhaps what's more interesting to me is this recovery trend that's been in place since the March low. So we're 12 months into this recovery trend. The euro has spent much of this year just backing off. We've seen US dollar strength because perhaps expectations are that rates will rise sooner than expected. So we had seen the euro trade back to this longer term trend line around 116.70, that sort of area. So euro dollar is always an interesting one to watch. But if you want to focus on the dollar, I think it's an even better market than that. So I think a really interesting market to watch, one that lots of people don't, and I think they could be missing a trick, is the dollar index. So it's DXY on our platform. So you can see the description here. The dollar index serves as a benchmark for measuring the relative value of the US dollar to a basket of currencies, including the euro, yen, pound, Canadian dollar, Swedish krona, and Swiss franc. So it's a really good blend of the US dollar. And I think it's interesting when we look at what's happened over the last year. We saw investors and traders run to the US dollar in March of last year as the pandemic really started to spread. And since then, we've seen the dollar index go from about 104 to trade down to 89. And I think what's interesting here, it was down at this sort of area. If we went back to 2018, early 2018, so 3 years ago, we saw the fortunes for the US dollar really turn around. And I wonder, is that what we're seeing this year? We saw that euro backing off from that high, that 2.5 year high. And we are seeing dollar strength. So I do wonder, is this going to be a comeback? So the dollar index is always a really interesting one to watch around any Fed announcements. Then, of course, there's what's going on in the bond markets. I've brought up here an iShares. It's an ETF, but it tracks the 20-year Treasury bond. So you can see in the description, the fund seeks investment results that correspond generally to the price and yield performance of the long-term sector of the US Treasury market. So I think this is always a really interesting one to see how it's reacting and it's tracking the bond market. And this is another one that's had, a pretty volatile 12 months, as you'd expect. In March last year, has been selling off, gone from 171 down to about 133 recently. But again, before it really accelerated in the first few months of 2020, this is where we saw quite a base for the Treasury. So I think this ETF that tracks that market is another interesting one to keep an eye on. Like the US dollar, are we going to see a change in fortunes for this market as the Fed perhaps has to change its stance on inflation and interest rates? It's going to be a really interesting few months. That's it for our look at the Fed and some of its more recent policies. I hope you found it interesting. It's something that will continue to affect financial markets. It will be a fascinating year to see how it reacts if we see the economy continue to recover much more strongly than expected. But for now, from me, David Jones, and Capital.com, we'll leave things there. Good luck with your trading. For more trading videos just like this, please subscribe to our channel.